has collapsed. And it's almost like, all right, U.S. election is behind us. Now back to your regularly scheduled global debt crisis. Or at least that's my takeaway from this story that's coming out of Germany, combined with what we saw yesterday and the market's, in my opinion, wacko reaction to Donald Trump's re-election. Do we call that re-election? Whatever happened yet? I don't know. But look, guys, some unusual happenings in Germany. So what happened? German Chancellor Olaf Scholz has fired Christian Lindner, the country's finance minister. Now, I don't know all the German parties and German interior politics all that well. So I'm going to break this down into a simple left-right thing. I'm going to get like the liberal Democrats or the progressive vanilla Democrats, whatever the names are wrong. Scholz is to the left of center, and he is in favor of more spending, more debt. And Lindner is to the right of center. He is in favor of lower taxes, less debt. That's a gross oversimplification, but that's what's going on there. The country has a big problem that it's facing right now. Scholz wanted to, number one, raise the borrowing limit. Germany has a strict debt ceiling, very similar to what we have here in the States. By the way, the debt ceiling comes back on January 1st of 2025. So that is going to be the first thing that our new president has to deal with on day one is going to be the debt ceiling. Just a reminder, Republicans, you're supposed to be deficit hawks. Remember that when you're in power. So Germany, they're wondering about raising their debt limit. Scholz also wants to increase spending on things like renewable mandates, on things like their climate change goals. By the way, guys, keep in mind, the German energy grid is a joke at this point. Remember, the country has been deindustrializing for the last couple of years. Actually, right now, Germany is in a period known as the Dunkelflaut. And I didn't even know this was a thing. Who had Dunkelflaut on their 2020s bingo card? And no, a Dunkelflaut is not when you have to flush twice because the first one didn't quite get the job done. Apparently, a Dunkelflaut is the term for that time of year when the German power grid doesn't really work because the wind isn't blowing. And it happens so often that they have a name for it because they're so hopelessly dependent on intermittent renewable energy. And when the wind ain't blowing, there's no power. And so what little natural gas generation, coal generation they have is pretty much it for the grid. So that fluctuation in energy prices has put a lot of German industry out of business, especially the German autos. More on autos in a second here. So more spending on renewables is one of the things that they're fighting over. Also, Scholz wants to raise taxes. Of course, Lindner's saying you shouldn't raise taxes. We're already losing businesses. Why would we raise taxes on businesses that are already on the brink? And of course, Lindner's solution is to cut spending on social welfare programs, on entitlements. And Olaf Scholz, that's a non-starter for him. And so, stop me if you've heard this one before, guys, because it sounds a lot like that bickering that we get here in Congress. Well, while all this is going on, now Olaf Scholz is calling, or there's rumored to be calling for snap elections, basically the same thing that happened in France a couple of months ago. And it's just a matter of, okay, guys, the election is behind us here in the States. Now we've got to deal with this global debt crisis. And the German bond market is spiking right now. There's big moves in the German 10-year Bund. Interest rates are rising because they're fearing a debt binge. I mean, we've got all these articles about what's going on in Germany. If you take and pick and choose a couple of things here and there, you can kind of see what's going on. And then you look at what happened yesterday. What did we have yesterday here in the States? We had how big was it? 16 basis point move in the 10-year Treasury yield yesterday in the United States. While everybody was celebrating, my Bitcoin is up, my tech stocks are up, this is up, the Dow is up 1,300 points yesterday. The bond market was flashing a warning in the United States. Hey, there is a debt crisis on the horizon. And you can even see it in some of the language here in the States today, talking about, Donald Trump was reelected. Does this mean fewer rate cuts from the Federal Reserve because they're worried about tariffs and inflation coming back? So be on the lookout for some more hawkish language from the Fed today. It seems like now I'm not sure we're going to get that hawkish language, but the market is certainly calling for it right away. And guys, we were talking about this in the lead up to the election. I said over and over again how much I thought it really didn't matter. And I know a lot of you guys didn't want to hear that. But in my opinion, spending and the fiscal recklessness, which is the biggest threat to the global economy, in my opinion, was not even on the ticket. nobody even talked about it. And when the biggest problem in the world is not even spoken about, then it sure as hell isn't going to get solved, which means the problem is going to get worse. And when global debt problems get worse, you end up with bond market crises. And we're already seeing the makings of that in both Germany and the United States here this morning. Now, on top of that, we've got more stories going on in the auto space. Auto layoffs. Nissan is laying off 9,000 workers globally. No word about which country that's going to be. Nissan does do some manufacturing here in the States, though. They just reported earnings, a 70% decline in operating income. Now, I've had some people in the comments tell me I'm being excessively negative about the auto industry. I don't know. You guys let me know. A 70% drop in operating income. Am I being excessively negative about that 70% drop in operating income? When your profits fall by 70%, that's a pretty big problem in my opinion. So maybe I'm being excessively negative. I get it. Doomer, perma-bear, written right here on the arm. I wear that one. I accept that. I resemble that. But it's hard to overreact to a 70% decline in operating profit. They also cut their revenue outlook for the year by 9%. Things are not looking good for Nissan. And Stellantis is back in the news. We can't talk about problems of the auto industry without talking about Stellantis. They are the Boeing of the car world. Stellantis announced 1,100 indefinite layoffs. Now, I don't know what an indefinite layoff is. I mean, why don't we just call them layoffs? I don't know. I mean, they're doing temporary layoffs at other plants, and they're like, okay, these aren't the temporary layoffs. These layoffs are indefinite. All right, why don't you just call them a layoff? Why don't you call them permanent? Oh, permanent didn't test so well in your focus group. Okay, so we're going to say indefinite. Maybe we'll leave people with a little bit of hope that maybe their job isn't going away permanently, even though we have no plans to put them back on the payrolls or bring them back in for a shift. Stellantis is cutting 1,100 people from their Jeep Gladiator plant in Ohio. So we've got more than 10,000 layoffs announced in the automotive space this morning, and people really aren't even really talking about it. This is flying under the radar. The car market is a freaking mess, much like the real estate market. Nobody can afford them. The interest rates and the prices are so high that the industry is basically frozen in place. And I got to wonder, guys, all those realtors out there, and I know a lot of realtors, are they making any money? There are no transactions happening in the real estate market right now, and realtors work on commissions. So commissions are hard to come by if there are no transactions, at least if my calculations are correct. So what the heck is going on in the real estate market while we're on that subject? I know that was a little tangential there, guys. What else we got? We got some earnings today. We got Papa John's reported a big decline in same-store sales, something we've heard a lot about in restaurants. That's another industry that is just not doing so well. Same-store sales declines despite inflation. And remember, guys, same-store sales are not even inflation adjusted. So if you're seeing a decline in same-store sales, you can add the rate of inflation to that negative number, and it gets even bigger. So the restaurant business, Papa John's, is no exception. We've seen the same thing from any number of the chains over the last couple of weeks. Barrick Gold came out with their earnings. Kind of interesting. The miners continue to lag the underlying metal. The all-in sustaining cost, the cost of labor, the cost of fuel, all their other operating costs. Barrick Gold just not really participating in this rally in the metals. They did see their realized cost for the metal that they're selling go up, but that was more than offset by increases in operating expenses. And last but not least, we got jobless claims data. Just came in a few moments before we went live. Initial jobless claims were in line with expectations, 221,000. That's up by about 3,000 from last week, below some of the recent highs. Nothing too alarming about the initial jobless claims, but keep an eye on continuing jobless claims. That weekly data point, it went up, and it went up big this morning. 1,892,000 continuing jobless claims. That is a spike of 39,000, a big miss, and it's the highest since November of 2021. The unemployment rate is set to rise. We haven't seen it yet in the BLS data, but we missed it just barely with that last jobs report because the unemployment rate went from 4.05 to 4.14, which is still technically 4.1 to 4.1. But the continuing jobless claims, it is reflecting the same reality, a weakening in the labor market. And of course, those layoffs in the auto industry are certainly not going to help. Why don't we shrink my big melon of a head and let's see what we got going on in the world today. Don't forget that like button for the algorithm. And if you're new here, hit subscribe and come back tomorrow and have your coffee with the melon heads, because we do this every day Right now, the S&P 500 is up 18 points, 0.3%, a little bit of positivity, adding to yesterday's miraculous gains in the S&P. The Dow is barely clinging to positivity here, up 3 points or 0.01%. It's about to go negative. Is it going to go negative? Me and my big mouth? No, it's still there. Still just barely positive for the day. The NASDAQ, meanwhile, up 114 more points, 0.5% higher this morning. So stocks are up pretty much across the board, albeit just barely for most of them. The tech stocks are rallying again here. We've got a slightly weaker dollar giving back a big chunk of yesterday's gains. Meanwhile, the DXY, or the US dollar index, is at 104.52. That's down about 56 basis points after rising about 150 points yesterday. So that slightly weaker dollar should put some upward pressure on stocks this morning. Now, looking over at the bond market, we are also giving away some of the gains in interest rates from yesterday. And keep in mind, guys, interest rates heading lower. That's bond prices heading higher. We've got the 30-year yield at 4.569. That's down about 3 basis points. The 10-year, 4.391. That's down almost 4 basis points. And the 2-year is at 4.220, down just under 5 points. The 1 month, meanwhile, is down 1 point here at 5.69. So we got a little bit of movement lower in bond yields, a little bit of people buying bonds today ahead of the Fed's rate decision. Looking over at commodities, we've got some green in metals here. Spot gold at 2,683. That's up about $25 here, about 0.9% higher, recovering some of the sell-off yesterday. Spot silver, meanwhile, 31.57. That's up about 40 cents or 1.3% this morning. We've got copper is up 3.7% here. Platinum is up just a tick, a fraction of 1%. Palladium is down about the same amount. Crude oil, meanwhile, down about 47 cents a barrel. That is for WTI futures in December at 71.22 here. That's about 2/3 of 1% lower. And Bitcoin is also taking a breather after hyperventilating yesterday. Bitcoin ripped higher by about $6,000 yesterday. Closing, well, Bitcoin never really closes, but at the end of the day, we were over 75,000. We're back below that level here, down about $800 this morning, 74,821, which would be an all-time high outside of yesterday's rally. Now, let's talk about what's going on in Germany here, guys. Germany's Scholz fires finance minister, collapsing his ruling coalition, the chancellor to seek a vote of confidence in January amid a worsening economy. Germany's center-left Chancellor Olaf Scholz announced Wednesday he was firing Finance Minister Christian Lindner, signaling the collapse of the ruling three-party coalition that relied on Lindner's pro-business party. Scholz announced the move at a news conference following weeks of disputes among the coalition partners over ways to boost the country's ailing economy. He said he would seek a vote of confidence in January that he said might lead to early elections that otherwise would be due next September. I feel compelled to take this step to prevent damage to our country. We need an effective government that has the strength to make the necessary decisions for our country, Scholz said. Now, Lindner is from the pro-business Free Democrats. He had rejected tax increases or changes to Germany's strict self-imposed limits on running up debt. Scholz's Social Democrats and the environmental Greens, who are also part of the coalition, wanted to see massive state investment, spelled even more increases in spending, and rejected the Free Democrats' proposal to cut welfare programs. So, this resembles the debt limit debacles that we have here in the States, which are coming back here. Disagreements on spending, debt, tax, renewables. I mean, this is your typical left versus right debate. And so you've got a collapse of the ruling coalition in Germany. Now, we've got more discussion on this topic here that kind of gets into what's really going on. Germany's looming snap vote throws a wrench into energy goals. And a lot of the reason why things are so bad in Germany's economy is because, to put it mildly, Germany's energy policy Germany's run by imbecilic idiot children when it comes to energy policy. It's like, okay, let's just put Greta Thunberg in a pantsuit and put her as energy minister. That's basically what you would get. You'd get Germany's energy policy here. So, high energy costs and an uncertain transition to cleaner fuels have been a key driver behind Germany's exodus of industrial giants in recent years. The ruling coalition's sudden dissolution and looming snap election will make the problem even harder to fix. The government, led by Social Democrats, Greens, and Liberal Democrats, forged in the early days of the energy crisis, once found unlikely common ground in its response to soaring gas and power costs and defense spending. But Chancellor Olaf Scholz said the burden posed by higher energy prices was among key areas that led to the coalition falling apart, with hawkish Finance Minister Christian Lindner opposing relief for grid fees and pushing to delay the country's climate goals. Germany shouldn't have to choose between spending on its energy transition, defense, or welfare, Scholz argued in a late-night address after he dismissed Lindner on Wednesday. So Scholz is saying, yeah, we shouldn't have to choose between renewable energy, defense programs, and welfare. In other words, I want. All these things are important, and therefore the money must magically appear to pay for these things. Well, again, as long as you pretend like, this Keynesian modern monetary theory stupidity where there's limitless government spending without consequence, well, then, yeah, you shouldn't have to choose between your priorities of spending. But everybody else operates in the real world where choices have to be made. And no, we can't have everything we want because life is hard and it's not fair and all that stuff we tell to children when they're throwing tantrums. But we forget about that when it comes to politics and government spending. So the nation is already falling behind in climate obligations for sectors like transport and buildings and could miss its 2030 targets if it doesn't implement policy measures fast enough. So Germany's their energy goals here, okay, the coalition falls apart. And then we get to the reality of financial markets. Fear of a German debt binge flips the key market gauge for the first time. And the reason I'm spending so much time here on Germany, guys, is because this is coming to the United States. I was talking about this in the lead up to the election, and I think it's almost here. Traders braced for the possibility of more bond sales, i.e. more government borrowing in Germany, after Finance Minister Christian Lindner, a figurehead for fiscal conservatives, was sacked, leading some in the market to contemplate a new administration that could be more tolerant of higher debt. Yeah, that's just what this government needs, is more debt. I was just thinking that, you know what the world really needs is more reckless deficit spending. A widely watched gauge of angst about bond supply rose, with the German 10-year yield climbing above the equivalent swap rate for the first time on record. In another sign of growing fiscal concerns, the premium on 30-year debt over 2-year notes advanced again, lifting the spread close to its highest in more than 2 years. And Jeff Snyder over at Eurodollar University did a video about this very topic yesterday. It's a good video. I highly recommend you check that one out. Now, the difference between bond yields and swap spreads and swap rates, otherwise known as the swap spread, it's an important gauge of future issuance because bonds tend to weaken relative to swaps as the market anticipates more sales, i.e. more government spending, more government debt. The move accelerates a long-term trend that has picked up pace across the world, reflecting investor fears over higher debt supply. All right, that's what I want you guys to focus. And that's the takeaway from the stream today. Investor fears over higher debt supply. Nobody talked about this in the election, but we all saw this coming. I was pounding the table on it. And this is why I believe the election didn't really matter so much, because nobody is addressing that. But now the election is over. And so we're getting headlines like this. The exact same story playing out here in the States. It looks a little different, but it's the same underlying debate. U.S. bond yield spikes, sending a warning to King of Debt Trump. Long-term Treasury yields surged on U.S. election results, and Trump's tax cuts and tariffs are seen lifting the deficit and inflation. Donald Trump's sweeping win in the U.S. presidential election set off a torrent of buy signals across Wall Street. There was, however, one notable exception, as traders sent assets from stocks to the dollar rocketing on optimism that a second Trump administration would be good for business and stoke an already strong economy. Investors in the $28 trillion U.S. Treasury market sold bonds, driving yields to the highest in months. The sell-off is a reminder of a powerful constituency. The so-called bond vigilantes are monitoring the self-described king of debt as he claims an unprecedented mandate to carry out an agenda of tax cuts and tariffs. It's a new day in America and a new day in the bond market, said Ed Yardeni, the veteran strategist who coined the term bond vigilantes in the early 1980s to describe investors who sought to exert power over government policies by selling their bonds or merely threatening to do so. The fact that Trump won with so much support gives him a tremendous amount of power, not only here, but on a global basis. The bond market is rightly concerned about fiscal policy continuing to be stimulative, with deficits already very wide. Guys, that is what's happening in Germany, and it's coming soon to the United States. That's part of what we saw yesterday, that big spike in U.S. 10-year yields. They're worried about fiscal policy. We've been warning about this. It's kind of showing its face early in Germany. I'm a little surprised to see it, but it is the same debate. It's happening all over the world. And we sooner or later, we need to face the reckoning with this. All right. There is a finite supply of money. We can't keep making more money because it just steals from existing money. We've all gone through inflation. Do we really want to do that again? I hope the answer to that is no. Ask me again in a few months. But right now, yeah, guys, it's already happening in Germany. It's coming here to the States as well. The debt ceiling starts January 1st, 2025. Get ready for that one again. All right, shifting gears from the fiscal mess in the U.S. and Germany, let's talk about the auto sector here. Nissan cuts outlook, announces restructuring with 9,000 job cuts, more problems in the auto sector. Nissan struggled to cope with tougher car industry conditions and address weaknesses within its business has spiraled, leaving the automaker with no choice but to slash payroll production and its forecast for the fiscal year. The Japanese company will dismiss 9,000 workers globally and reduce capacity by a fifth, among other cost-cutting measures, after net income plummeted by 94% in the first half. Yeah, Jack, you're overreacting to the auto market, and there's still 6% of net income remaining versus where we were 6 months ago. Yeah, you're right. I mean, let's put some lipstick on that pig here. A 94% drop in net income in 6 months. Nissan also will sell off some of its stake in Mitsubishi Motors after burning through 448 billion yen. That's about $2.9 billion in cash during just the last 6 months. The calamitous results will prove costly for CEO Makoto Uchida, who's forfeiting half his compensation starting this month. The CEO told investors Nissan had been affected not only by external challenges, but also by our specific issues, alluding both to the breakneck rise of Chinese automakers and Nissan setting overly ambitious sales targets. Nissan now sees its operating income plunging to just 150 billion yen in the fiscal year ending in March. That's down 70% from its previous forecast. And management also lowered their revenue outlook by more than 9%, meaning they now expect virtually no growth for the year. So, I mean, that's a pretty damning assessment of the state of things for Nissan. Now, Nissan stock didn't actually do that bad yesterday. It was up 2% to, this is priced in yen, 410 yen a share. The market loves layoffs, guys. That's the takeaway here. Anytime we've seen companies announcing mass layoffs, their stock has reacted profitably or reacted positively to that news. Nissan, no exception. Now, Stellantis is saying, hold my beer or hold my sake. I don't know, whatever, if you want to make a Japanese joke out of it. Stellantis to indefinitely lay off 1,100 workers at a Jeep plant in Ohio. Why bother saying indefinitely? I don't get it. They're just trying to soften the blow, I guess. Automaker Stellantis announces plans Wednesday to cut a manufacturing shift and indefinitely lay off roughly 1,100 workers at a Jeep plant in Ohio. Guys, these articles are all starting to run together. Every week, I'm talking about another few thousand layoffs at Stellantis. These are not the same story over and over again. This is 1,100 more indefinite layoffs now. The company, which has been battling high inventory levels and lower earnings this year, said the decision at its Toledo South assembly plant to cut production to one shift will better align output with demand of the Jeep Gladiator pickup, the factory's sole product. The layoffs will be effective as early as January 5th. According to Stellantis, the automaker announced the layoffs in conjunction with required notices to government agencies under the Worker Adjustment and Retraining Notification Act. In other words, WARN notices. The United Auto Workers Union, which represents Stellantis employees at the plant, did not immediately respond to a request for comment. Now, that's important there. Keep an eye on the UAW and Stellantis. They just had a strike last year. There was a big contract negotiation. The UAW got a big raise. That was supposed to be the end of it. But now Stellantis is laying people off like crazy. And something tells me the union is not just going to sit this one out, that they are going to be back in court or back on the picket line even any day now. So another 1,100 people. Stellantis stock, again, reacting positively to the news. This market loves layoffs, 2.3% higher ahead of the opening bell, priced at $14.19, up about 31 cents. And speaking of layoffs, we got another one hit the tape just yesterday. Massachusetts-based Charles River Labs cuts 1,300 workers and will close over a dozen sites. Not going to spend too much time on this one because we're getting a little long here, guys, but Charles River Labs, this is a private lab that serves the biotech industry. All right. So a private lab in biotech cutting 1,300 workers. What's going on here? I suspect this has to do with high interest rates. Biotech companies, research into drugs and pharmaceuticals. I don't cover this sector very much because I don't like the sector or the people in it very much. But biotech is highly susceptible to higher interest rates because they tend to be pre-revenue companies, startups that are dependent on the debt market in order to finance their research in hopes of making some breakthrough and then making billions of dollars when they get bought out by one of the pharmaceutical giants. Well, higher interest rates means it's harder for these biotech companies to access the debt market and to borrow to sustain their operations, and therefore they're making cutbacks. And, well, the labs that serve those biotech companies, they're making cutbacks along with it. So you got another 1,300 jobs going away at this private Charles River Labs in Massachusetts because of problems in the biotech industry that I suspect are the result of higher interest rates. So there you can kind of see how the Fed and their rate hikes translates into job cuts and higher unemployment and suppressed wages. This is the mechanism of Fed tightening and its effect on the job market. You can see it right here in this headline. Now let's talk about Papa John's earnings. This one just came out. Papa John's stock zigzags after revenue tops estimate while profit matches. Papa John's International was moving between gains and losses early Thursday after the pizza chain posted better than expected revenue for the third quarter, but same-store sales that lagged expectations. So the revenue was pretty good here, but look at some of these numbers here. North America's same-store sales fell 6% from a year ago. If you add 2 or 3% inflation on top of that, you're looking at a decline in sales of 8 to 9% for Papa John's. As the domestic company-owned restaurants were down 7%, North American franchise restaurants were down 5%. The consensus was for a 4.4% decline. International same-store sales fell 3%. That's interesting. So pizza is doing worse here in the U.S. than it is everywhere else in the world. That's kind of surprising. Global system-wide restaurant sales fell 3%. Guys, same-store sales declining in restaurants. We've seen this. We saw this with Burger King. We saw this with, Restaurant Brands International, Yum Brands. We've seen Pizza Hut going bankrupt. What was the other? Cracker Barrel going bankrupt. A lot of restaurants are in big trouble here. Papa John's, no exception. Now, a little bit of negativity was already priced into this stock. So Papa John's has been pretty volatile today. Let's refresh this one and see where we're at here. The bell just rang. Papa John's stock is up about 1.5% here, $58.21. So it looks like the market was expecting some of this negativity here, not overreacting to it. But the restaurant industry, you can add that one into the same basket as the auto industry. They're just not doing that well there. It's a reflection of the state of the economy for the average person, something you rarely hear about in the mainstream financial press. Although, have you guys noticed a shift in the sentiment in the financial press? Have you noticed how fast the financial reporters are wiping the lipstick off of that pig now that they're no longer running interference for one political candidate or another? You notice how they're suddenly a little more willing to face reality with the state of the economy? I wonder if that's going to change more in the weeks ahead. That's interesting. Side note there. We also got initial jobless claims data just came out today. You can see it in the chart here. Initial jobless claims rose slightly to 221,000. That's up 3,000 from last week. So a slight rise in initial claims, but you guys can see we're well off the highs that we saw in October. So nothing too alarming about initial claims. There's no big spike in people losing their jobs, but that's only half the story because the people who are losing their jobs are having a very difficult time finding a new job, and that's resulting in accumulations in the unemployment benefits. And you can see that in continuing jobless claims, which saw a big spike here this week. We're now at 1,892,000 continuing jobless claims. That is up sharply by 39,000 from last week, and it's also higher than the spike that we saw 2 weeks ago. Guys, if you zoom out, this is the highest level we have seen since November of 2021. So the unemployment is accumulating. If you look at a 3-year chart, you can see it a little bit better. Now, this is the pandemic levels here, guys. These aren't really comparable numbers. You can see unemployment fell really fast with all the stimmies and all the payroll protections and all the free money that the Fed was hanging out. And then as soon as we stopped, March of 2022, you can see the unemployment rate stopped falling and it started climbing in 2023, kind of stayed flat for most of 2024. Now we're starting to see it climb again. Pay attention here, guys. The unemployment rate, weakness in the labor market, that jobs report that we got last week was just a terrible jobs report. I wonder what the Fed is going to say about the labor market today, because we've got the FOMC press conferences coming up. Now, we had a weak payrolls report after a very strong payrolls report the month before that. I don't know what Jerome Powell is going to take away from that. Now, on top of that, you've got prospects for a crackdown on illegal immigration here in the United States. A crackdown on illegal immigration will result in a reduction of new labor supply flooding into the country. So that's going to put upward pressure on wages. Look for some questions for Jerome Powell about immigration, about wages, about the effect of the election on Fed policy. Now, just let's step back from all of this for a minute here and let's talk about it. The independence of the Fed is a very important topic. The market or the press is going to be talking about Fed independence. You're going to hear questions about that today. They're going to be saying, are you worried about Donald Trump's mean tweets about the Federal Reserve again? Now, that's important. I do think we do need an independent Fed, or I should say, if we're going to have a Fed, it should be independent. I don't think we need a Fed at all. I think we should just get rid of it and see what happens. Just try it and see. You might like it. You never know. It's like, have you tried not doing heroin? Maybe you'll like it. I just throw it out there. An addict will certainly be revolted by the prospects of that, but hey, you never know. Life might be better without the heroin that is easy money. But guys, let's be honest. We have not had an independent Fed. When they made Janet Yellen the Treasury Secretary and Jerome Powell, you're talking about two Fed officials running the Treasury and running the Federal Reserve that finances the Treasury. We have not had an independent Fed for some time. So, Donald Trump and everything he's going to probably say about Jerome Powell. Now, Trump is going to be saying, I want more easy money. I want QE to come back. He's going to be saying, I want you to lower interest rates so my stock market could go higher. That's not what's good for the economy. I have no doubt Trump is going to call for these things. And look, guys, I had a lot of people saying, Jack, I never knew you were a raging liberal in the comments yesterday. Anybody who's known me for any period of time would probably laugh at that, guys. Trust me, I am not a liberal, but I also live on planet Earth in reality. Donald Trump wants lower interest rates to send his stock market higher because he views the stock market as his report card. And so he is going to be a big proponent of easy money for the next few years. That is not what the country needs. The country needs the easy money to stop. We are a nation of heroin addicts. The bond market was flashing that warning yesterday. So you can ignore the political posturing that's going to come out of the FOMC press conference today, because you've got a press corps that is overwhelmingly liberal, that is going to be looking for gotcha talking points about, Jerome Powell says this about how dangerous Donald Trump is. But at the same time, guys, let's keep Orange Man honest. When it comes to the easy money, we all just went through the inflation in 2021 and 2022. Donald Trump had a hand in that because a lot of that money printing happened on his watch, even though he never accepts any responsibility for that. And he's going to be demanding even more of that because he wants his stock market to go higher. Again, let's temper the partisanness and let's live in a real world. Money is a fixed asset. Resources are limited. You can't just print money into existence and expect there to be no consequences. That has not changed because Donald Trump is going to be president now. That remains the reality. And I just want to say thank you very much to Mish for the 10 Nobody Special Finance memberships. Al Midnight, those are my feet. Thank you very much. Midnight just came in. He's looking for food. Mish, thank you very much. Shout out to all my melon heads on YouTube. I appreciate the support of the channel, as well as your help as a blue wrench, keeping things neat and tidy in the comments. And thank you to JJ Watt, who says DNN this week will be epic. Was it a doomy week, JJ? I'm not sure if it was particularly doomy or not, but we will keep an eye out on that. I'm always in the market for doom. By the way, DNN, that is my side project that I do with my buddy Travis from Real Estate Mindset, as well as Miss Melody Wright, two other fantastic channels that you guys should be following. There is a link to DNN in the description down below for you guys on YouTube. Thank you, JJ. And thank you to Aunt Janet's Wig, who says, what are your thoughts on Ron Paul vowing to join Elon Musk to reduce government spending? Do you think that will offset the increase in spending? Answer the last part first. No, I don't think Elon Musk's government's efficiency office, if they ever make it, I don't think it's going to really have that big of an effect on spending. Also, look, Elon Musk, Elon is out for Elon. I think one thing that is definitely not going to be on the chopping block is going to be subsidies for electric vehicles in Elon's efficiency bureau, or whatever they're going to call it, the Department of Pretending to Care About Government Spending. I like that Ron Paul's going to be in there. I would rather put Ron Paul in charge of that than Elon Musk, because I think Elon might take away from certain projects and then add to others that just happen to be good for Elon. Not knocking the guy. It's just Elon is out for Elon, and it's like anybody else. Ron Paul, though, I would love to see it. I'd love to see Ron. Let's throw Rand Paul on there while we're at it. Let's put some libertarians on this government efficiency bureau, whatever it's going to be. I like the idea. I'm doubtful. I'm skeptical that they're ever actually going to do anything. Are they going to release a 1,000-page report with recommendations, and then Congress is going to look at that and say, "Oh, thanks," in the garbage can, more spending anyway? So, I'll believe it when I see it. Let's put it that way, Wes. Appreciate the super chat and the support of the channel. Grandpa, thank you for being a melonhead for 8 months. He says, to fix, just freeze spending levels at 23 levels. That's too high. Too high, Grandpa. I like the sentiment. I love the idea of freezing spending. But even 2023 levels, we ran like $1.5 trillion deficit in 2023, didn't we? Even that is too high. And even that probably won't happen, because if we do freeze spending, they're going to talk about, well, we were supposed to increase spending for this program, and therefore, since you didn't increase spending in this program, you're technically cut spending in this program. Oh my God, he doesn't care about grandma. He cut the spending in this program. That's the stupidity we're going to hear, all these like overly emotional arguments. Like Olaf Scholz saying, we shouldn't have to choose between windmills and defense spending and welfare. Like, oh, we shouldn't have to choose. Well, life is hard. It is unfair. Resources are finite. Take it up with the laws of physics. It is what it is. It's not anybody's decision. If you just print money to pay for everything, you're just further victimizing people. I think we've learned that lesson by now. I think. Is it safe to say we've learned the lesson? Have people learned that money printing equals inflation yet? God, I hope so. But you know what? That angry piece of fruit is still out there buying SMCI calls. So I guess people don't learn their lessons. I don't know. So, maybe I'm putting a little too much faith in human intelligence here. But thank you so much, Grandpa, for being a Melonhead member. And thank you very much to Steve Woitis for the super chat, sir. He says, would love to see the new admin audit the agencies that report fiscal data. Get the spin out and the truth back in the numbers for CPI and jobs numbers. I love the sentiment, Steve. I would love to see it. Once again, I am going to express a healthy dose of skepticism, because have you heard the Donald speak? And again, guys, I know people in the comments don't like when I say bad things about Mr. Orange, but Donald Trump is not actually a champion of accurate, unbiased data, is he? So I would love to see more accurate jobs and inflation data. You'll forgive me if I don't hold my breath waiting for that. I'd love to see it, Steve. I think it has gotten to ridiculous proportions, the way they juke the data to portray people in a positive light. I think that's ridiculous, and it's dangerous. I think the data is too important. It needs to be above politics, as do many other things. But call me skeptical. I just don't think we're going to see it. I hope we do, though. Thank you, Steve, for the super chat and the support of the channel. And thank you, everybody, for having your coffee with the Melonheads this morning. I appreciate you guys very much. Shout out to all my Melonheads and magnanimous Melonheads on Twitter and Patreon. Links down below. Chronicles of Red Drift. The real problem with spending is Congress. Mostly yes, but the president does have that veto pen. He can make that go away with the swipe of his pen. He can demand a budget, but they don't do it. Thank you very much, Chronicles of Red Drift, for sneaking that super chat in at the end. Hi, Mom. Hi, Dad. I love you guys. Everybody, till next time, live small and dream big.